Hello, Oracles. Today we're going to go over some stocks that are on my buy list. Now, for those of you who have been following me for a while, you know that my spreadsheet right now for my entire portfolio is very simple. It all does the calculations for me, tells me how much money I have to spend and where to spend that money. So, what I've been looking at lately is some stocks that have been coming up on my buy list and my portfolio telling me to buy these. And that to me tells me that, they're coming down in price. And so I'm adding to them. So I'll go over those today. There's a few stocks on there, and there's a couple that are getting pretty close, and just kind of like sectors that I'm looking at to be buying into. Now, none of this is financial advice. This is strictly my strategy for my own portfolio, what my portfolio is telling me to buy based upon where I have my criteria set. So you guys need to do your own due diligence and research as to what is going to be best for you and your portfolio. Now, if this is content that you guys like, please hit that like button, subscribe to the channel, and let me know in the comments below, how do you guys decide what stocks or ETFs you're going to be purchasing? Do you have a strategy? Do you have a formula? Do you just kind of wing it? Please let me know in the comments below what your strategy is. All right, before we get into those stocks, we're just going to discuss a little bit about the macro environment first, because this morning we got the PPI data that came out, and it was very similar to CPI. Everything came in line with expectations, except for the core month over month came in at 0.3 versus an expectation of 0.2. But based upon the numbers and the fluctuations, nothing to worry about whatsoever in those numbers. And based upon the market reaction today to that, no reaction whatsoever. We started the day a little bit higher than yesterday, and they just kind of crept up from there. So next week we get the FOMC meeting, and we're going to be hearing from Jerome Powell what the rate cuts are going to be. Right now, many people are expecting a 25 basis point cut, and chances are that is what we are going to get. So again, that'll come up next week. We'll discuss it as we get closer and see if there's any other information that comes along. But today we're going to go over what stocks came up on my buy list as things to buy into, because even though the stock has been kind of volatile, but typically going up over the last few months, there are still some opportunities out there. So there have been a lot of these stable to medium to high income ETFs that I've been buying into, but most recently in individual stocks. Today, I had my portfolio tell me that I should buy into Occidental, to Google, and ExxonMobil came really close to buying into, because it's right on that cusp. And it's, the oil trade has been down. Oil is way down. It's under $70 a barrel. So those stocks have been feeling it as well. So my portfolio telling me that these are all down. So going in with the first, ExxonMobil. So ExxonMobil and Occidental are two plays that I'm looking at when it comes to oil. Oil is going to come back. I'm a big proponent of EVs, electrification of the whole entire world, but I know very well that we're way behind the curve when it comes to the grid. The grid needs to be improved significantly. We are not making strides fast enough to catch up to it. So oil and ICE, internal combustion vehicles, are still going to be needed for a very long time. Oil is still going to be in high demand for 5 to 10 years minimum. We still have oil used in many other things around the world, home heating oil, so many different things that are still going to transpire. So maybe in the long run, we're going to end up seeing oil fading off, but I don't think that's going to happen in the next 5 to 10 years. So it's not like this downtrend in oil prices is caused because of all the electrification going on out there. I think it's just caused because prices are coming down. So again, we are going into a winter time where demand typically goes back up. At least here in the Northeast, we haven't really had much of a winter over the last few years. So the demand has been dwindling. We'll see how it goes this winter. But to me, this is just one of those, this is a buy the dip opportunity when it comes to oil and oil related stocks. So for me, seeing ExxonMobil and Occidental dip down as they were was a buying opportunity. Again, when it comes to my portfolio and how it stretches out, it tells me that, hey, these stocks are selling off. They are below my threshold that I want to buy at. I should buy them. But then I will also take a look and say, well, why are they dipping down? I don't just blindly follow my spreadsheet. And I've done a lot of the research ahead of time to even put these stocks and companies and ETFs into my spreadsheet and into my portfolio. But when I take a look at it and I say, hey, it's down, let me just double check and make sure there's nothing going on fundamentally with the company. And then I buy from there. So again, neither of these companies have anything going on with them wrong fundamentally. They're just pulling down because of the fact that oil is coming down. That's all. So then you take a look at yourself and you ask, hey, do I think oil prices are going to come back up? If you do, then that tells me that, hey, this is probably a good buying opportunity for these oil companies. If you don't think oil is ever going to come back up and you do think that this is the end of oil forever, then you probably don't want to buy oil companies. That's totally up to you. Again, you have to make the best decisions for your own portfolio. But for me, based upon the information I'm looking at, that's where I ended up putting this money is into those two companies because I still think that they have a good runway ahead of them. So then we look at Google. So why has Google been falling down? Now, Google is an outstanding company, obviously one of the Magnificent Seven, one of the best tech stocks out there, but it is trading at the lowest PE of all of the tech stocks that are out there right now when it comes to those big names. So when it comes to the Amazons, Apple, Microsoft, all those companies, Google is under a 20 PE ratio right now. Now, when you start looking at the company from a fundamental basis, you can say, hey, they have kind of been falling by the wayside when it comes to the AI movement. So you can say, hey, they haven't really been moving in the same pace and direction that some of these other companies have. Maybe they're never going to catch back up and they're going to end up falling down from here. But you do have to remember that they do have the number one search engine in the world and they have YouTube. So between those two, that is massive revenue drivers for them. So are those two things going to go away? Maybe, maybe not. We've got Elon Musk saying that he's looking at coming up with a search engine that is going to be completely non-biased and it's not going to have anything else in there with the algorithms that may pick or choose what you're going to be seeing from, whatever view standpoint you want to say. So who knows what's going to happen there if Google's actually going to have any true competition out there when it comes to search engines. We shall see if that ends up transpiring. I don't know if it's going to happen anytime soon, but I still think Google is going to be one of those top companies out there. They're still run very well from a management standpoint and from a financial standpoint. So it's just a matter of, are they going to be able to make that turn when it comes to AI? But now we've also been hearing a lot of things about how the return on investment with AI just isn't there yet. I have no doubt it's going to get there in the future, but we're just not there yet. So right now we've got a lot of the companies that are out there investing in all these NVIDIA chips like Blackwell, and they're going out there and spending a ton of money right now to build that infrastructure up for their AI, but they haven't got that return on their investment yet. So this could be something where maybe 2 years down the road, those investments are going to pay off. So maybe in a year like 2026, we will start to see some bigger numbers when it comes to AI revenue generation, and they won't have those underlying costs because those have already been absorbed now in this year in 2024 and some in 2025. So we'll get that revenue coming in at a later date. So is this something Google's looking at right now and just saying, hey, you know what? We can wait till maybe the next iteration of chips that are coming out. Maybe we wait till 2025 to invest in all of this. Maybe they're doing some things behind the scenes right now. Again, we don't know for sure. Obviously, what we see on the face right now is not as strong as some of these other companies that are out there, but it's Google, so there's a good chance that they are working on something. You can say the same thing about Apple. Apple is now having Apple Intelligence that's out there that's going to be on the phones and other devices. So we'll see how that transpires again. So it's just a matter of, hey, who is going to be the winner that comes out of this? Is it going to be one? Is it going to be multiple people? And Google obviously is going to be one of those players that is going to be at the top of the list for potential winners. So for me, when it tells me that Google is down, I think it's a good buy for my scenario. I don't have a lot invested in them, so I'm still just kind of trickling some money in. And I always pay attention. If at some point, we see that Google clearly is not going to be a winner in this space, and maybe the revenue is going to flatline or go down, I will easily sell off that company and I will buy into something else and put that money elsewhere. So that's my strategy for that one. And that's just kind of how my whole entire spreadsheet has been working, is telling me these things. Makes life so super simple. I don't have to think about things. I don't have to get my emotions involved. I just use straight up logic. My spreadsheet says these are below your threshold. I take a look. Hey, is it worth adding at that point? Cool, it is. Let me add that money to it. Done. Not a problem. And so I just keep on taking it from there. And so looking at some of the other companies that are going on right now, like this is what happened to me with REITs. So REITs for me back in July and August, and actually heck, up until basically July and August, I kept on adding to those and adding to those. I have Vici Properties, I have Prologis PLD, I have Realty Income, which is O. I was buying into all three of those heavily for the first half of this year because they were getting hammered. They were down pretty far. I was buying Realty Income for under $50 a share. It's now over $60 a share. So looking at things like that, just based upon, hey, my spreadsheet's telling me to buy these things, it has been working out very well so far. And so now looking forward as to what's going on with the entire market and what I think could be doing well as buys right now, I'm not looking at it from a swing trader standpoint. You could possibly take some of this information as a swing trader and say, hey, these are beaten down sectors. These are beaten down companies that are probably trading well below their value. But when I'm looking at it as a long-term investor standpoint is, hey, I'm basically buying the dip. If you're looking at a 401k that is just taking your money on a regular basis and just dollar cost averaging into the market and into your 401k plan, it doesn't take a look at price. It just buys regardless of what the price is. And historically, we have seen that that strategy is going to beat out trying to time the market every single time. Time in the market beats timing the market historically on average every single time. So that's kind of what I set up for my own regular portfolio is just I have money coming in and it's just putting money in the areas that are beaten down the most. And when you're doing something, let's say like the financial crisis, or even COVID when we got the massive dip there, if you had a 401k at that point, assuming you weren't trying to cash out of your 401k and you were still adding money to it, you would have been buying at a massive dip and you would have never known where the bottom was going to be. You just kept on buying and buying and buying on a regular basis. And you kept on lowering your cost basis on a lot of the companies that you owned just because the stock price kept on coming down. So you were lowering that cost basis and basically buying low. And that is the strategy of the market, is to buy low, buy companies at a good value. And if you don't know how to go into a company, read their earnings reports, read their annual report, kind of give an actual valuation to that company to see if you're getting a good deal, a strategy like this, or just buying into ETFs, could be a very good strategy to get started, to get into the market, because that is basically like dollar cost averaging. So dollar cost averaging, even for a beginner, is going to be one of the best strategies until you learn how to actually value companies. Then you can say and make better assessments and say, hey, you know what? I'm waiting for this specific price. I think the company is good at this price. I will buy it there. My dad does that. He has a lot more time to be able to do this as he's retired, and he's very good at it. He will go out there and he takes a look at companies and he'll value them and say, hey, you know what? Based upon some of the algorithms, based upon where the charts are looking at right now, and looking at support and resistance lines and taking the company's valuation, hey, I think this is a good price to buy it at. I can do that as well. I just don't have that kind of time to go in there and do that. So I kind of give myself a basis and I do the research ahead of time and say, is this company going to be good long term versus what price do I want to buy the company at now? And I just let that dollar cost averaging take over for me. Perhaps in the future, when I get to do this full time, I will go back to actually valuing those companies and doing it that way. But as for right now, this dollar cost average strategy has been working out very well for me. With my buys that I made today, I added on another $1 per month of income coming in. And this snowballs over time because those companies that I'm buying in those individual stocks, I do have that drip on. I have dividend reinvestment on. So as we do get those paid out, and I just got paid out on ExxonMobil, so I had $3.87 put into ExxonMobil just recently. So again, it doesn't sound like a lot of money. It's $3.87, but I'll guarantee you right now, if you found $3 on the ground walking by, you'd probably be pretty happy about that. Cool, I found $3. So I found it. It ended up going into ExxonMobil. Guess how many hours I put into working for ExxonMobil? 0. Guess how many hours I put into working for any of the companies that I own? 0. And guess how much money I get paid on a monthly basis? $415 for putting in 0 hours of work. I work less than the CEOs of these companies, yet I get paid for them. So I get paid more per hour because it's infinite than the CEO of all of these companies. This is why I like dividend investing, because for me, I get to put in 0 of my time other than doing the research I need to for the companies, updating my spreadsheet and things like that. But other than that, that's for my own portfolio and basically my own business. So I'm putting hours into my own business and I'm recouping money from all of these companies that I don't work for. So that's why I have switched a lot of my strategy over to the dividend investing. And again, I still own Tesla. I still own the growth company. Like Palantir just got included into the S&P 500. So companies like that I think are going to do very well long term and could potentially pay out dividends will give me a good return on my investment as of right now, in my opinion. So I've done the research on those and I think that they're going to do well. SoFi is another one of those. So they are also on my spreadsheet, but they're further down on the list with a smaller threshold to hit when it comes to the amount of money I want invested into them. So for me, I would say that they're underweighted. The way some of these firms do it out there in institutions and analysts, they've got, overweight, underweight, equal weighting. So I guess you could say that's an underweight thing. And it's not because I don't think the companies are that good. It's just because for me and my strategy going forward, those growth companies, I'm just underweighting right now. And I'm going to be putting more money into them as time goes on. And over time, if they start paying dividends, I'll shift them up into another category where that hits another threshold and I'll add more money to them at that point. Similar to like a Palantir going into the S&P 500, now all these institutions who invest in companies in the S&P 500 will automatically have to put more money into Palantir. So that's kind of how my portfolio works. As soon as they go into a different threshold and they start doing dividends, I add more money into them. Just bottom line like that. So kind of set up my portfolio a lot like an analyst or an institution, and I just build it that way. So for me, those are the companies I added to today: ExxonMobil, Occidental, and Google. And I explained the reasons why with the oil trade, I think that's going to turn around. And you guys can let me know your thoughts in the comments below. Do you think the oil trade is going to turn around? And do you think Google is actually going to come through with their AI and turn things around and become a favorite again when it comes to those high-tech stocks? Thank you guys so much for watching. I appreciate all of your support. Have a great one.